You might have spent years building up an investment portfolio. Perhaps you've invested in shares, ETFs, crypto, but now you're thinking about making a move overseas and you're wondering what happens with my Aussie investments if I cease being a tax resident in Australia. Do you have to sell everything before you leave? Is there going to be some tax payable when you leave? What happens if you just do nothing and just get on a plane and go? The answer to all of these questions is, and unfortunately I'm going to give you those two words that most people hate hearing from accountants, it depends. One thing I can say is that there is potential for expensive tax problems if you do not know the rules before you leave. So in this video, I'm going to explain some of the main things that you should be aware of if you're planning to leave Australia and you have investments. So first up, can you keep your Australian shares and your other investments if you are planning to leave Australia's tax system? The answer is yes, but it is important to understand that the way your investments are taxed will change after you become a non-resident for tax purposes. So if you're talking about dividends on a share investment portfolio, it's going to matter what kind of dividend it is. Is it a franked dividend? That'll be treated differently to an unfranked dividend. There will usually be withholding tax on an unfranked dividend, and the rate of withholding will depend whether or not your country that you're living in now has a tax treaty with Australia. So depending on what it is and the nature of the dividend will determine how it's taxed, whether it needs to go on a tax return, whether you need to report it at all. In some cases, you won't need to report it on an Australian tax return. Now let's talk about the exit tax. Most people who have considered leaving Australia to go move overseas, who have researched the idea, they've probably come across the exit tax. What is it? Well, the exit tax is a capital gains tax event where the ATO deems you to have disposed of your CGT assets at the time when you become a non-resident for tax purposes in Australia. The effect is here, even if you did not sell these shares, let's just say you've got some Aussie shares, some BHP, some CBA, some NAB, whatever it may be, you own these shares, you did not sell them, under the deemed disposal rules, the ATO will treat these shares as if they were sold, which will trigger a capital gains tax event. So potentially you're going to have to stump up some cash in order to satisfy the ATO on the way out. I should note as well that this does not apply to property. Property is a whole other kettle of fish. I won't really get into property in this video. That deserves its own video altogether because there is a whole other set of rules that applies there. But we're pretty much talking about more or less most things except for property. So shares, crypto, ETFs, precious metals, things that you would normally pay a capital gains tax on if you sold that asset for a profit. Now regarding the exit tax, you do not necessarily have to do this. There is an option to defer the gain. What does this mean? It means there is no exit tax, no deemed disposal, but instead you pay tax at the time when you actually do sell the asset. This does sound pretty good on the surface, but I would say be very careful if you're going to choose this option. You may escape a tax bill now, but potentially your ultimate tax position at the end of the day could be much worse off. That's not always the case, but most people tend to choose the exit tax option. Pay your bill, you're out, you're free sort of thing. But just keep in mind that there is an option there to defer the capital gains tax event if that makes more sense for you. Now let's talk about the CGT discount, and of course this is undergoing some major changes right now with the Australian 2026 budget. Probably the worst budget in living memory for a lot of investors and business owners. So there is going to be some changes there, but we can still talk about the discount and how it will apply as a non-resident, keeping in mind that when this actually happens for you in the future, you may be on the 50% discount or you may be on the indexation model. So most investors know when you hold an asset in Australia for longer than 12 months, you are generally eligible for the CGT discount. Now here's the important bit. The CGT discount is generally not available to non-residents. You have to be a resident taxpayer in order to be eligible for the full CGT discount. But you don't necessarily need to panic depending on your gain and how long you've held the asset. It might not be too bad for you. Just because you've left doesn't mean that you wouldn't be able to get the CGT discount at all with your share market investments. It might just be more of a partial application of the discount, but certainly something to keep in mind and take note of when you're doing your tax planning. Now in this video, I've been pretty much talking about investing in Australia from the perspective of an individual, so I own the shares in my name. I'm not talking about whether you own the shares in a trust, in a company, in a self-managed super fund. All of these entities will have different implications and different rules that have to be navigated as a non-resident. So there you have it, guys. These are some of the main things that you want to be thinking about when you're starting to plan a move overseas and potentially exiting Australia's tax system. Everything changes for tax, so you need to sort of know what's going to work best for you. If you want to make moves before you leave, any restructuring that might be required and that sort of thing. Are some investments better off being sold, or can it still work quite well for you as a non-resident? You got to go through everything sort of asset type by asset type, structure by structure, and how it all fits in together. Now, if you're interested in learning more about this and how it applies to your situation, we've got the Exit Tax Kit over on our website. You can go there, have a look at that. That will give you a blueprint for ceasing tax residency in Australia, all the steps you got to do, pre-departure checklists, post-departure checklists, and how to set yourself up on the other side to optimize as well. If you're looking for more one-on-one assistance, maybe you want some professional guidance around your residency status, or maybe you want to work with us to map out an exit strategy to get things done right so there's no nasty surprises on the other end. There's a link in the description. You can head over to our website from there and get in touch that way. I'll leave the video there, guys. Thank you for watching. Catch you later.